Let me ask you a quick question. Let's say you have two investments. Over the last year, Investment A gave you a 25% return. Investment B gave you an 18% return. Which one was the better investment? The obvious answer is investment A, right? It made more money. But what if I told you that to get that 25% return, investment A took on a massive amount of risk, while investment B's 18% return was steady, stable, and low risk? Now, which one sounds better? This is the central problem for every investor. It's not just about how much money you made, it's about how much risk you took to make it. And if you're not measuring this, you're investing blind. In this video, I'm going to show you exactly how to measure this, using a powerful tool called the Treynor Ratio. By the end of this, you'll be able to look at two funds and know, instantly, which one is giving you the best, most efficient return for the risk you're taking on. So, what is the Treynor Ratio? In simple terms, think of it as a bang for your buck score for your investments. It was developed by economist Jack Treynor, and it answers one simple question. For every unit of market risk I take on, how much extra return am I getting back? A higher Treynor ratio is always better. It means your investment is working smarter, not just harder. The formula looks a little technical, but I promise, it's simple. It's your portfolio return, minus the risk-free rate, divided by your portfolio beta. Whoa, okay, let's break that down. First, portfolio return. That's the easy one. It's just the return your investment gave you, like 10% or 18%. Second, the risk-free rate. This is what you could have earned with zero risk. Think of a US Treasury bill. If a T-bill pays 3%, why would you risk your money in the stock market for a 2% return? You wouldn't. So, we subtract this free 3% from our portfolio's return to see the extra return we got for taking a risk. And third, portfolio beta. This is the most important part, and it's the key to understanding everything. Before we go any further, we have to talk about beta. You've probably heard that the stock market is risky. But not all stocks have the same kind of risk. Beta measures a stock's or portfolio's volatility, its risk, relative to the overall market. The market is usually an index, like the S&P 500. Here's the simple breakdown. The market itself is given a beta of 1.0. If your stock has a beta of 1.5, it means it's 50% more volatile than the market. If the S&P 500 goes up 10%, your stock might go up 15%. But, if the market drops 10%, your stock could drop 15%. It's riskier. Now, if your stock has a beta of 0.8, it's 20% less volatile. If the market drops 10%, your stock might only drop 8%. It's more stable. So, beta is the perfect way to measure systematic risk. That's the kind of risk you just can't avoid, even by diversifying. It's the price of admission for being in the market. Okay, so back to the ratio. Why do we divide by beta? Because we want to know if we're being paid for the risk we're taking. Let's go back to our formula. The top part, our return minus the risk-free rate, is our extra reward. The bottom part, beta, is our market risk. The Treynor ratio tells us our reward-to-risk score. This is so important. A fund manager who gets a 30% return sounds like a genius, but if their fund's beta was 2.5, they just took on a ton of risk to get it. They basically just got lucky in a rising market. Another manager who got a 15% return with a beta of 0.8 is arguably a better manager. They delivered solid returns without white-knuckling it through wild market swings. The Treynor ratio cuts through the noise of high returns and shows you who is actually skilled at managing risk. Alright, let's walk through how you'd actually calculate this. Step 1. Get your portfolio return. You can find this in your brokerage account or on a finance site for a mutual fund. Let's say your fund returned 12% last year. Step 2. Find the risk-free rate. This is the current yield on a short-term US Treasury bill. A quick search will tell you. Let's use 3% for our example. Step 3. Find your portfolio's beta. This is the tricky one. If you own a single mutual fund or ETF, you can usually find its beta on sites like Yahoo Finance or Morningstar. But what if you own 20 different stocks? You'd have to find the beta for each stock and then calculate a weighted average based on how much you own of each. Honestly, calculating your portfolio's beta manually is complex and a huge pain. It's the number one reason people don't use these powerful ratios. That's exactly why I built a free, easy-to-use calculator on my website, Fincalconline.online, to do all this for you in seconds. You just plug in your numbers, or for some tools, just your tickers, and it does the hard math instantly. It'll save you a ton of time and help you make much smarter decisions. I'll put the direct link to the calculator in the description below. It's totally free to use. Okay, let's do the math ourselves one time to really see it in action. Let's compare two different large-cap tech funds, Fund A and Fund B. The risk-free rate, we'll say it's 3%. Now, Fund A, the go-getter. It has a 15% annual return. And it has a beta of 1.5. So, it's pretty risky. Then, there's Fund B, the steady Eddy. It has a 12% annual return. Less exciting, right? But, it has a beta of only 0.9. Very stable, and less risky than the market. On the surface, Fund A looks way better. 15% beats 12%. But let's calculate the Treynor ratio. For Fund A, we take 15% minus 3% and divide by its 1.5 beta. That's 12 divided by 1.5, which equals 8. Now for Fund B, we take 12% minus 3% and divide by its 0.9 beta. That's 9 divided by 0.9, which equals 10. Look at that. Fund B has a higher Treynor ratio. This tells us that Fund B's manager provided more return for every unit of market risk they took on. Fund A just gave you a wilder ride to get a less efficient return. Fund B is the smarter, more efficient investment. That's the power of this ratio. Now, a quick pro tip, and the biggest mistake I see people make. You've probably heard of the Sharpe Ratio. It also measures risk-adjusted return. People mix them up all the time. Here's the simple difference. The Treynor ratio, which we just learned, uses beta. It only measures systematic risk, or market risk. It's best for comparing funds within a diversified portfolio. The Sharpe ratio uses standard deviation. It measures total risk, that's market risk, plus all the weird, random risks of a single company. It's best for evaluating a single investment or an entire portfolio as a whole. So, if you're comparing two tech funds to add to your already diversified 401k, the Treynor ratio is your tool. If you're deciding to put all your money into one single investment, the Sharpe ratio is a better fit. Alright, let's wrap this up. What did we learn? First, stop chasing returns. Don't just look at the high score return. You must account for the risk you took to get it. Second, Treynor is return per risk. The Treynor ratio is your bang for your buck score. It tells you how much extra return you're getting for every unit of market risk you take on. Third, higher is always better. When comparing two funds, the one with the higher Treynor ratio is the more efficient investment. So here's your action step. The next time you're comparing two funds or ETFs, don't just stop at the 1-year return. Go to the free calculator I linked below at Fincalconline.online. Find the Treynor ratio for both and see which one really deserves your hard-earned money. Thanks so much for watching. If this video helped you, click that subscribe button. I post practical finance videos like this every single week. See you in the next one.